Welcome to Shareholders of a Better World, brought to you by TBLI Group. At TBLI Group, we have an established reputation as an organization dedicated to building the ecosystem of global sustainability and impact investing. We're doing this through educating, advising, and facilitating transactions in global sustainability and impact business, as well as capital solutions for private companies, family offices, and fund groups. For nearly 25 years, TBLI Group has created a vertically integrated ecosystem of education to action through TBLI conferences and TBLI consulting. More about our company can be found at tbligroup.com. This webinar is brought to you by TBLI Foundation, which hosts educational learning experiences dedicated to a better planet. Through the foundation, we build sustainable communities by sharing the people and the experiences making a difference to so many of our lives around the world. Our weekly podcasts bring impact thought leaders that are doing and not only chatting. Now let me introduce my guest today. Good afternoon from our studio in Amsterdam. Before I introduce our special guest today, just some instructions for those of you who never joined our system before. So if you have a comment or a question, just type it in the lower right-hand corner. If you want to clap or you find something funny or brilliant, there are 3 emojis in the lower right-hand corner, might be your left-hand corner, that you can press, and that will capture that applause or funny, or think that something's funny or brilliant. If you need to send a private message to anyone in the chat, just move your mouse or your cursor over their name and a window will pop up and you can send them a private message. So I'm really happy today because one of my favorite nerds has joined us today. Melanie Reback is the CEO and co-founder of Radically Open Security. So she's basically an ethical hacker. She's hired to break into corporations and banks to test their security system. But she's also one of the most prolific individuals I know fighting for true economic justice. And she's been working on an interesting idea. She always has interesting things going on non-extractive finance, which she was going to share with us and tell her what the hell is non-extractive finance, and tell us a bit about her journey. So, Melanie, thank you so much for joining us today, and the floor is yours.
Thank you, Albert. So, hi to everybody here. You all saw me from a previous TBLI talk where I was talking about non-extractive businesses and post-growth entrepreneurship. That's not what my talk is about today. So my talk today is about what I call non-extractive finance. Of course, this leads to the questions of, what do you mean by non-extractive? I'll get to this. But first, I want to express something. Investment is a political act. You can think about this, there is a difference, of course, between investing with George Soros versus the Koch brothers. We can immediately see how this shapes the world in either one direction or the next. However, the problem here is that many of us with ESG, and with our social enterprise, and with our triple bottom lines, and with our SDGs, we are trying to make the world better, but we're trying to do this in this way of, doing well by doing good, right? But the problem here is when we're talking about that triple bottom line of the people, planet, profit, falling underneath the profit component, half of that profit is reinvested margin, which you need to run either a company or a financial institution. But that other half of the profit is extracted. And that extracted profit is greenwashing. We know that we have a greenwashing problem in ESG. And we need to recognize the fact that this is killing the credibility of those of us that are politically in the progressive left to be able to make the kinds of improvements that we want to, because you have, of course, in recent times, Elon Musk, pointing out, he's shouting that ESG is a scam, right? And pointing to the fact that I think it was ExxonMobil is in a certain ESG index while Tesla was removed. How can this be? This, of course, is leading to a movement that, unless you've had your eyes completely closed, you can see it these days in the newspapers. A lot of people on the sort of conservative right or the alt-right are starting to shout an awful lot about so-called woke capitalism, right? Or woke finance. And we're starting to see a political backlash against this. One form in which this is taking, of course, in the United States, there has been quite a few recent developments that, of course, many of us in the progressive left are not necessarily happy with. Of course, the Supreme Court, Roe versus Wade, things have been moving in a particular direction, right? And some people like this, other people don't like this, but in either case, this is a trend. However, one of the things from 2021 that I think caught a lot of our attention of those of us in the ESG also just recently caught the attention also of those on the right. Engine number one. So we all know the really wonderful story of engine number one, right? They came in with 250 million of asset under management when they were partnering with CalPERS, and they went to engine number one and they said, hey, gas and oil exploration is out and renewables is in. So could you please reallocate your cash away from gas and oil and towards renewables? Needless to say, ExxonMobil was not on board with this. What then happened, of course, was engine number one formed a coalition with the big three investment firms, so BlackRock, Vanguard, State Street, and they also got Institutional Shareholder Services, ISS, who is also responsible for providing proxy voting advice to many of the institutional investors on board. And with this coalition, they managed to replace 3 of the members of the board of ExxonMobil with climate activists. Heartwarming story, for those of us who are worried about climate change. However, 2 things. One, of course, what comes next? Of course, can we keep this up? It was also the most expensive proxy battle that was ever conducted. I think it cost roughly 30 million for engine number one to conduct this. But the other thing also is that, unfortunately, as much as the progressive left, I would say, was inspired by engine number one's action, I think also those on the right also understood that they need to embrace these same methods. So what wound up happening was in Texas, of course, it's a red state in the United States, and quite recently, the politicians essentially, they have been campaigning against this woke finance. So what they've been doing is they have been using their power as legislators to force the pension funds in Texas essentially to defund the big three. And instead, they are putting that capital with what I would say are kind of like conservative right-wing investment fund managers. These investment fund managers are making the promises that they are not going to get involved with anything related to ESG or anything related to the SDGs. But it actually even gets worse than that. If you look at the direction also that this is moving in, this capital can also be used to do board takeovers of so-called, quote-unquote, woke companies. So you've got, say, Disney, right? And of course, Disney got involved in a really large conflict with DeSantis in Florida over things like the Don't Say Gay law that was passed. And of course, Disney, well, they lost a whole lot of tax breaks and other kinds of, accommodations they had from the state of Florida. But what would happen if all of this pension fund money that is being divested from the, from the big three is then being used, for example, to replace board seats of Disney? At that point, what can happen? Of course, the new board members can appoint a new CEO. And then once a new CEO is appointed, then at that point, what they can do is they can use the entire resources of the Disney Corporation. And that's huge, right? I mean, we're talking about, huge multinational corporation, essentially for their political aims. There's another thing also that can happen with this. What can happen is that this company now, for example, Disney, could then make political donations. In fact, an unlimited amount of political donations back to that politician who forced the pension fund to divest and go with those alt-right fund managers in the first place, thus coming full circle. Of course, once these board takeovers and leadership changes happen, it's going to take a whole lot of time to undo it. And then they can basically pull the money out again and then repeat this process with other companies. If those of us on the progressive left aren't scared, we should be. Because there is basically a war that is brewing in finance that is coming up at this moment, and most people don't even see it. And those of us on the progressive left with our ESG, we are content to do well by doing good, by, supporting our extractive social enterprises and having our extractive fee structures with the 2 and 20, so we can then basically, we need to get that greenwashing out of our ESG, or we are going to lose credibility. The other thing also is we need to embrace this kind of shareholder activism. Of course, most of the time when you say the word activist, people get really cringy about it. I mean, particularly in the finance sector. But we need to understand that we need to embrace this, because if we don't, the other side will, and we are going to lose. So basically, what this means is really twofold. One, we need to consider shareholder activism and what this means, and also the proxy voting system in general. And we need to think carefully about things like, for example, how do we bring true democracy into corporate governance via shareholder voting? There's some really great initiatives that are happening right now, some of which were prompted by engine number one. So post engine number one, they started this index fund that's called the Transform 500 ETF, ticker symbol VOTE, and it's basically an S&P 500 tracker using the Morningstar index, and it tracks the index. That's it. But it's a fair trade product. So it essentially uses the proxy votes of that, of the people who invest in that fund to support their shareholder campaigns, to reform companies in this sort of, ESG friendly kind of way. So in that sense, it's like fair trade. It's putting an alternative product on the market that if you just put your money with this one instead of that one, just with engine number one instead of with BlackRock, then you know that you're going to get this other result. So BlackRock, of course, saw this movement, and they started making noises about things like the pass-through of proxy votes, basically to the ultimate beneficial owners. In other words, people like us, because if you look at pension funds and if you look at most investment funds, the money that's in there most of the time is ours, our money. But we don't get to vote because we have given the right to vote to these fund managers. And essentially our wishes are not being respected. Now, BlackRock is working with a company that's called Tumelo, and they are polling basically the pensioners or the ultimate beneficiaries of whoever's money is in whichever fund to actually ask about our voting preferences. This is a good development. As You Sow, led by Andy Behar, is doing something that is almost even more earth-shaking. And what they're doing is they have set up a system that is called As You Vote. As You Sow, and they're a shareholder activism organization in Berkeley who's been filing hundreds of shareholder resolutions. They're doing really excellent work. But they're also creating a platform so that normal people can essentially get the voting advice either from them or from somebody else. And then they're using Broadridge, which is basically the same electronic voting platform that a lot of the institutional investors are using, and enabling those people to then be able to vote, the retail investors or these ultimate, anybody who has the right to vote. So we, the people, we, the small people, can use this kind of a system to make a decision about, what we actually want our money to be voting for, right? Now, the normal argument against the pass-through of proxy votes is that, yeah, but normal people don't have the knowledge, they don't have the awareness, they don't know enough about finance or about bookkeeping or about accounting, or, they don't understand their own fiduciary duty, and they're not going to be able to make informed decisions. This, of course, is a good argument, but you can say the same thing also with general elections, for political office. For example, I'm a U.S. citizen who lives in Amsterdam in the Netherlands. I still have the right to vote in local Florida elections, despite the fact that I've been living out of the state for quite a large number of years. It means that I'm completely out of touch with who those local politicians are. I get a ballot, I see a bunch of names. If there's sometimes there's a Republican or Democrat next to it. If they label it that way, I know who to vote for. But if it's just the things like judges, I just see a list of names. I don't know who they are. I don't know what they stand for. I don't know what their political stances are, which basically means that indeed in such situations you can't just Christmas tree it and think you're going to get a good solution. Now, what I do in those particular cases is I find a local expert or a local advocacy group or a local pundit who I know espouses the same views that I do. For example, I could go with a group, for example, called the Dolphin Democrats, which is a GLBTQ positive, friendly lobby group. And every year they offer voting advice, not just for the general elections, but even for the primaries. And I know that our votes are probably similar. So I can basically just go Christmas tree in their voting card. And then I know, I hit send and it's done, right? So in this particular case, I still voted, but I relied upon the informed advice of somebody who knows what they're doing and has a particular set of opinions, which I presumably would agree with. Now, the beautiful thing about As You Vote, of course, they are a progressive organization, but in this As You Vote platform that they're putting out, they need to be able to make it impartial so that both sides can equally have their influence. So what they can do is put together the voting advice, not just for As You Sow, but let's say the Koch brothers have some advocacy organization and they're providing an alternative voting advice. You can basically have both sets of voting advice on the platform. In fact, anyone who is an influencer or an expert of any kind can issue their own voting advice. And then the people, sort of at the bottom who've had their proxy votes passed through can basically look at that slate, say, well, I know I agree with this guy, and then basically select that voting card, hit send, and it's done. These kinds of small automation changes can bring an earthquake to how the world is run. Because what these efforts are doing is they are bringing true democracy to corporate governance. Too many of us right now are just simply not voting because, again, we get the proxy, voting cards with just this blank list of names. And It's the same thing with in ESG, divestment versus engagement. You can't change the world by not voting. We precisely have to engage. So I think that with finance, we need to consider that we need to get into this space. I can remember having conversations with some chief investment officers at certain banks and saying to them, hey, so how do you feel? You're a very progressive organization. How do you feel about proxy activism, voting activism? And he said, I really support engine number one. I really love what they're doing. I'm cheering them on. But the problem is, how am I going to explain to my stakeholders if we're purchasing shares of ExxonMobil? It's too complicated of a message for us to get across. We need to get over this hesitation. And again, we need to understand that this is a political arena that more and more of us who really are concerned about the way that the world is going in. We have to step into this political arena, because just stepping back, just saying, I can't get involved, because I might have difficult conversations with my constituents or with my customers. We need to get over this because, we are in crisis situations, not just because of the climate, but because of social considerations and in general, the way that the world is moving right now. And we can't avoid being involved in these things any longer. Similarly with ESG, and presumably it's being a sham, and talking about the fact that the extraction is actually the greenwashing that's happening from these funds. We need to look at role models of people who are creating less extractive investment vehicles. For example, Daniela Baroni Suarez from Snowball Impact Management. She is running a VC fund of funds, a fund of impact funds in London, in the UK. And she has reformed the fee structures to basically go from the extractive 2 and 20 fee structure, basically into the cost of doing business. Now, first, let me explain really quickly why 2 and 20, which is very common in the entire investment industry, why this is extractive. The first thing is, let's say I'm a VC and I'm funding startups. The 2%, of course, is my asset under management fee that I'm getting from my limited partners. And the 20% carried interest is essentially the money that I get upon a successful exit. Now, this 20% carried interest, first of all, embeds the growth imperative into startups. This is why VCs are pushing startups to scale exponentially with these hockey stick curves and to sell off the company. Of course, this is not helpful, and it's certainly not helpful for social enterprises. However, if you talk to most impact VCs and you say, hey, impact VC, you say that, it's really about impact for you, but what would you think about reforming the fee structure to get rid of the 20% carried interest? Then they'll look at you and they'll be like, I didn't mean that. But this is a very uncomfortable conversation to have with impact VCs. In fact, I found that commercial VCs frequently are more receptive to having these conversations because they're not claiming to take the high road. They understand what they're doing is extractive. They're making money and they admit it. But the problem is, talking about extractive fee structures in social enterprise and ESG creates cognitive dissonance because those who are claiming to be taking the high road feel like hypocrites. And it's not that the individual people are hypocrites, but it's that the problem is systemic. A lot of the people have really great intentions, but they're just doing things because it's the same way that everyone else does it. And we need to start understanding there's alternative ways that we can do it. Now, the 2% carried interest is also, the 2% asset under management fee is also mega extractive. John Bogle, who was the founder of Vanguard, and he was also the inventor of the index fund, he used to say it as such, there is a tyranny of fees, right? And it is creating these conflicts of interest between the fund manager and the investor. Now, let's say that I want to retire, right? And I put my money into a 401k or, Roth IRA or one of these kinds of financial vehicles with a 2% management fee. After 25 years, given the historical performance of the stock market, I have given 2/3 of my returns to the fund manager. 2/3. Most people don't realize this, but it's because they don't understand compounding. Now, there is, if the fund is small, then that 2% doesn't amount to much. But if you start having billion-dollar funds and up, or if you're BlackRock or Vanguard or any of the big three, I mean, they are making so much money that essentially they can drive the fees down and they'll still be fine, with covering operations. It's this whole conflict of interest is part of the reason why John Bogle invented the index fund in the first place, because he wanted to create this mutualized, mutual fund that essentially drove fees down to zero. And with his index fund that he invested, because it was passively managed and there were no expensive investment managers who needed to make these decisions, he essentially did succeed in driving fees down to basically zero. Most of them I think are 4 or 5 basis points, and beyond that, I think even Prudential does an index fund completely for free as a loss leader. So that has succeeded spectacularly. Now, when the index fund first came out, they called it Bogle's Folly. But of course, so many years later, Vanguard is now one of the largest investment companies in the world. Clearly, and also passive funds are now 35% of all investment worldwide. And when I say passive investment, I mean index funds and also sort of their superset of ETFs, electronically traded funds, which are essentially the same thing basically as index funds, but just with where you can sort of put together the index yourself, and it doesn't, and it can be any basket, any combination of stocks that you like. Anyhow, but the point here is that John Bogle was attempting to create a kind of not-for-profit investment fund. He was way ahead of his time. Now, with Daniela from Snowball, she's essentially also doing the same thing with her VC fund of funds. She is taking that, first of all, she kicked out the 20% carried interest. And the second thing that she did is she reformed that 2% into the cost of doing business, assuming middle-class salaries and middle-class pensions. All returns and fees above and beyond that get reinvested into the fund itself. This is monumental. This is really an amazing, she's a wonderful role model of how we can do finance differently. She's not the only one. There's also another ETF that's in the United States that's called Impact Shares. And they also are running as a 401c3, a United States not-for-profit organization that were spun off of the NCAA, or I'm sorry, the NAACP, the National Association for Colored People. And basically what they did is they created this ETF. And if you buy the ETF, it's sort of the same story. It's a not-for-profit vehicle. So all fees and returns sort of above and beyond cost of operations are used to cross-subsidize donations to, you guessed it, the NAACP. So they also created a few other ETFs as well, one for gender, another one for climate, So there are some numbers of role models of these kinds of smaller fund managers who are showing how you can do things differently, and essentially by creating a kind of not-for-profit investment fund, we can eliminate the greenwashing from the investment vehicle. At that point, the only thing, and if there's no money that's being extracted from the financial vehicle, then the only purpose of being that's left is positive social impact. Now, I think the other element that you need to add to all of this is a golden share, which is adding essentially a construction that's called steward ownership. Steward ownership is usually a combination of foundation ownership and this golden share. And a golden share is this poison pill construction that prevents the entire company, the entire vehicle from ever being sold. Why would you do this? It's because we're trying to get rid of the perverse incentivization that causes people to make incorrect decisions, which usually result in externalizing costs onto the environment and onto society. We need to fix the world by changing incentive structures, right? It's like Charlie Munger says, you show me the incentives, I'll show you the result. But with ESG, we are so laser focused on climate, and decarbonization that we have lost sight of the fact that, the E, is a side effect, right? It's the same thing with S2. Society is suffering because of these externalized costs, and because of the financial extraction that's going to support the 1%, leaving almost nothing left over for the actual people who need it. If we want to fix ESG and eliminate the greenwashing, we need to look at the G. And unfortunately, except for people that are doing shareholder activism, G is the dust that is swept under the carpet, right? Whereas, E and S, they are the symptoms. And fighting those symptoms is not going to solve the crux of the real problem. If we fix the G, we will get the E and the S for free because there will no longer be any incentives to externalize these costs. And this is how we really need to solve the problem. Now, small fund managers are interested, for sure, in creating these kinds of alternative, non-extractive financial vehicles, including ones that embrace shareholder activism. But the problem is they tend to have trouble finding money. You need to have a certain amount of asset under management, otherwise you are going to drown in the fees of whichever platform is basically helping you to run the fund, whoever your appointed rep is. The point is that usually funds need to be at about roughly 100 million to break even. And the problem is you can do it a little bit more cheaply, but of course, you've got backstage capital. Even with Snowball, I think they're roughly at like 30 million right now, and they've implemented it more cheaply. But certainly if you wanted to do an index fund like the Transform 500 of engine number one, you need 100 million roughly to break even. Now, the point is most of these beginning fund managers get stuck at about 30. And it's because they go to family offices, they go to high net worth individuals, maybe they go to NGOs, they can get some, maybe from foundations, they can get some money here and there. But the institutional investors, forget about it. And it doesn't matter how much sympathetic they are to your idea, how much they understand, they will not touch these small funds with a 10-foot pole. There's a couple of reasons why. The first reason why is because of diversification rules, right? Most institutional investors are going to be investing with a minimum tranche size of about 100,000, and you need to be 10% of their, they need to be 10% of your fund or less, which basically means right out of the gate, you need $1 billion fund to even get any consideration whatsoever from institutional investors. Most beginning fund managers cannot aspire to this. Of course, BlackRock can snap their fingers and have that tomorrow. But that's because they have the distribution networks that most starting fund managers do not have. But this sort of leads to a chicken and egg problem. I think that probably the institutional investors would be happy to see such low-fee alternatives on the market, if only for the reason that having low-fee alternatives on the market brings market pressure, and it pressures the incumbents that are commercial to also lower their fees. And who doesn't like lower fees? The other thing that's nice about this whole thing is that by reducing the conflict of interest financially between the LPs and the GPs, what you're basically doing is de-risking the whole vehicle, right? And also and if you incorporate non-extractive companies below that, it's also de-risking the companies in the portfolio. It means better risk-adjusted returns. Who doesn't like that, right? But again, I mean, the problem here is that there is this cultural barrier that needs to be overcome. These fund managers, and particularly institutional investors, are incredibly risk averse. So if you come to them with something weird or with something small, let's say, hypothetically speaking, they were going to bet on you. Now, what happens if you don't manage to grow and your fund winds up folding? This is incredibly expensive for the LP. And it could even be a career limiting or career even ending move for that institutional fund manager. So there's this incredible culture of fear about doing something different. These, of course, are initiatives, these are really serious structural problems that need to be overcome. And I think that they can only be overcome, first of all, by education. I mean, the buck stops, with the pension funds. It also means that our society's problems start and end with the pension funds. I was at an investment conference, a sustainable investment conference, about 2 months ago in Miami, and I was talking with a fund manager, actually a sustainable fund manager from BlackRock. I don't have these conversations every day, but it was quite interesting. And I asked her, how can we get BlackRock to move the needle on things like proxy voting, to support, for example, more ESG or, she basically, and I gave her 3 alternatives. I said, so option number 1, we send Extinction Rebellion into your lobby. Option number 2, we write a article in the Financial Times. Or option number 3, we talk with the pension funds, and then the pension fund basically picks up the phone and gives you a call. I mean, she basically told me, look, Extinction Rebellion in the lobby, that happens anyway. We just ignore them. We walk by. It doesn't move the needle at all. An article in the Financial Times. Okay, it's hard to get an article in the Financial Times. So once it's there, we'll probably read it. We might give it some consideration, but it probably won't move the needle. However, if this pension fund calls us and they have a lot of money invested with us, and they say, we would like for you to alter your voting behavior, that will move the needle. So in other words, we shouldn't be sending the Extinction Rebellions of the world to BlackRock. We need to be sending them to the pension funds. And again, this sort of comes back to democracy in finance. We can and we need to talk to the pension funds. We need to embrace pension fund activism. There's very little of it in the Netherlands. There's some of it. There's some good role models like Make My Money Matter in the UK. But we need to understand that this is a serious thing. It's an issue that NGOs need to get involved with. We need more financial activism. And also politicians need to start raising awareness about these issues. Anyhow, I think I'm already, running a bit over time, so I'm going to wrap this up here, and we can go into some questions. But I hope that you have found this presentation to be interesting, probably somewhat confronting, and hopefully thought-provoking and leading you to new ideas. So thank you so much.
Thank you, Melanie. Definitely thought-provoking. A couple of very important points that the audience need to understand. Melanie has just proven either one of 2 things. Either she's a genius, or it's not really hard to understand finance. Because a year ago, Melanie knew nothing about finance. And in less than a year, she's completely grasped it. So either she's a genius, or the financial system is not that difficult to understand. Other point, it's fascinating that there's something in the water in Texas, because they are the world champion in fraud producers. Enron and Lance Armstrong both came out of Texas. So there's something over there. But I want to take exception with your idea. I personally believe I like basically second generation engagement, which is basically investing in the worst of class, in the small and mid cap, and using activist approach to change the behavior rather than voting your stock or hiring an engagement company, because it doesn't really achieve anything. It takes 5 years, you don't get anywhere. But you seem to believe in the voting, the traditional proxy approach. Can you clarify that?
Sure. I agree that a lot of the proxy activism focuses on large cap companies, and I think it would be a folly to not consider mid cap and small cap companies as well. Particularly, also with the engagement, it should be friendly engagement. It should be helpful engagement. We need to also approach them in such a way that we're saying, look, we're unpaid experts that are trying to help to make your company better. I think if we are less adversarial and sort of more helpful in this way, we might be able to also get some changes without it even turning into a proxy battle. If you look at things like As You Sow, also Share Action, I mean, they file hundreds of shareholder resolutions, and many of them are withdrawn. And the reason why they're withdrawn is quite simply because the company's board and management complies. They say, yeah, that's a good idea. We'll make this change. And they do it. So, and that is even better. It's not some symbol, some badge of success that you've, turned this into a battle. And if it really does turn into a battle, it is going to be very resource intensive to win. It's even much better to approach it less adversarially. And I also think the smaller the company, the more likely they probably also are to actually sit down with you and really to be reasonable and to want to work with you. So that's an incredibly good point, Robert.
I'm not so sure if the lack of lack of not saying I'm sorry, but your children are ugly, and kind of calling them out on their behavior. Because I mean, remember, you talked about the 20% carry. The private equity sector was the most active lobbyist to prevent the tax change, which just came through in this by bugging Cinema and Mnuchin to mention to vote, get that out of there. So I don't really believe anymore that kind engagement gets people attention. I think they need to feel significant pain. Pain does work. And just chatting with them, oh, this is the right thing to do. We've heard that for 40 years, and there's nothing been really done fundamentally on climate.
Look, here's the thing. I mean, if you want something from somebody, I think you need to start by asking nicely. And if they don't respond when you ask nicely, that's the point where you start showing your teeth. That's what it is. I mean, in general, you get more, I mean, just by human nature, I think you get more flies, with honey than with vinegar. But if indeed they won't budge and they won't make any concessions, then, that is the point, I believe, indeed, where you need to be willing to use some force, but it's expensive. I mean, with engine number one, as I mentioned earlier, it was a $30 million proxy battle. Most of us don't have these kinds of resources. Engine number one only got these resources because a foundation was willing to give them this money to be able to conduct this proxy battle, not to mention the sheer amount of time and energy and research that they had to put into this. Plus, on top of it, I mean, part of the reason why they won was because I think a lot of the LPs and, the institutional investors were anyhow already very unhappy with ExxonMobil because they had already been engaging ExxonMobil for a very long time, and ExxonMobil was being particularly recalcitrant. So it was, in that sense, kind of a perfect storm for engine number one, that they stepped in at the right time and sort of took advantage of that perfect, combination of.
You froze. Your screen froze. Hey there. Oh yeah. Oh, you'll come back. I'm going to take a couple of the questions now while Melanie. Yeah. Okay, are you back? Can't hear you. I think your Bluetooth is not working, Melanie. Melanie, yeah. Yeah, come back in. I'm going to start taking questions. Jock and Oliver have been the most prolific in the question area here. So as soon as Melanie is able to join again, always funny how the computer nerds always have the most difficulty with connecting these webinars. So while Melanie is joining again, I'm not really that convinced that the engagement and politely discussing things is working. I don't really, because I've seen it. I've seen it with the oil and gas sector for 40, 50 years, putting out false information, blocking things, and lobbying, and that. I don't think, I think that, I just don't really believe that that's the most effective way of doing that. So I think we lost Melanie over here. Let me see if I can get her back on the phone. Hang on one second. Melanie, we lost you. Okay, so I think her internet or something went down. So what I'm going to do is actually, oh, here we go. Okay, so she's having a lot of difficulty there, and I'm going to try something here. Let me call up Jacques to join us on the panel here. There we go. All right, Jacques, you had the most questions in the comments there. So why don't they're particularly the one that you asked about, while there's no denying that the challenge you are describing is real, to me, this describes very much the U.S. context, which is in another universe anyway, which is why I don't live there. To me, challenge is primarily a U.S. one and less of a global one. Do you agree? And if not, why not? I agree to a certain degree. Yes, I think a lot of garbage comes out of that country. They created the subprime collateralized debt obligation disaster. They created Enron, Lance Armstrong, and the fraud factories of the MBA schools. Oh, there we go. That's okay. Okay, so Jacques had a question, which I brought him onto the panel over here. While there's no denying that the challenge you're describing is real, to me, this describes very much the U.S. context. To me, challenge is primarily a U.S. one and less of a global one. Do you agree? And if not, why not?
Okay. I agree for right now that the issues and it's not just Texas, by the way. I believe it was also West Virginia was also doing the same thing with their public pension fund money. But remember that capital is global. So this pension fund money could potentially be used for attempting takeover of something like Disney, but it could just as easily be used for attempting to take over a European company or some other global company, because anyone from any location can invest in any company anywhere. So just because we are not physically located in the United States does not mean that we are immune to the consequences and effects of this problem.
Does that answer your question, Jacques?
Yes, it does, in the sense that I think you're right. But my one, thanks very much for the presentation, because it was challenging. But what frustrates me about this whole ESG discussion, that it's only being held through the lens of the financial industry. And in a way, also in this talk, what you're perpetuating is the financial industry self-image, which is that they are the masters of the universe and determine everything. And it ignores what is happening in the rest of industry. And a lot of companies are too slowly, sometimes with too little ambition, are starting to very much to move in the right direction on all three ESG fronts. And I think just because the financial industry behaves in the way it has consistently behaved all the time, which is that it's driven by fear and greed, doesn't mean that the rest of the world is behaving that way. With that, I'm not saying they don't have influence, but they are not the only influence. And I think by always taking the financial industry's lens, it ignores what is happening in the places where value is actually being created. Yeah, because let's be clear, the financial industry is a means to an end, not an end in of itself. Yeah. So
Yes.
that's what I struggle with.
Yes, I very wholeheartedly agree with everything you just said. I gave a previous talk, TBLI talk, that was called Post-Growth Entrepreneurship, and that was addressing, I would say, the other half of the equation. I agree with you that the financial industry is sort of its own isolated thing. It does influence a lot, but it doesn't influence everything. Entrepreneurship, grassroots entrepreneurship, is sort of the other half of the solution. Because however, we need to really look at our institutions and the structural ways in which we are raising our startups. Let's say I'm an impact founder and I want to create a social enterprise. Most likely, I'm going to go to some impact hub somewhere, and they are going to, first of all, talk to me a bit about social enterprise, B Corps, and all the usual kinds of structures. Then they're going to introduce me to an impact VC, and then I'm going to wind up, if I'm successful, probably, oftentimes it ends with selling your B corporation to Unilever. The problem here also is the moment that social entrepreneurs get into bed with impact VCs, we've lost. So I think that for startups, I think that if we want to build an impact startup, the most powerful thing we can do is bootstrap. Forget the VCs, forget finance, forget the investment sector, forget the entire financial industry. We don't need them. And we can basically create startups that bootstrap by selling services. We can use services to bootstrap products. And then, we then can try and embrace foundation ownership and steward ownership via golden shares to ensure that we can create non-extractive social enterprises. I think that's another part of the solution. It's completely independent of the financial industry, and we need to embrace this too. However, this line of thought, we need education, because most social entrepreneurs don't even realize that bootstrapping is a thing, or if they go to a incubator saying they want to bootstrap, I'm not going to say they're going to be laughed away, but they're just, but they might not be able to get the help that they're looking for, because there's very few incubators where you can go that will actually help you with bootstrapping and where that is their primary focus. I'm actually running such an incubator called Nonprofit Ventures. We've had 3 cohorts and incubated almost 50 startups already. And we specialize in bootstrapping and nonprofit ownership structures, entity forms, and golden shares. And, there are a fair number of social entrepreneurs with incredibly good intentions who want to do this, but we need to educate the educators. We need to get people working in incubators to understand there's a financial conflict of interest between their own business model, because most incubators take equity or they get some kind of referral fee, from the investors by referring the people through. One time I actually wanted to give a talk at one of these commercial VCs, and I said to them, hey, I'm already working with, other incubators, and I'd love to give a talk on new forms of social enterprise. And then they thought about it and they said, yeah, but our investors are investment banks like Merrill Lynch. So, I'm really sorry, but to be honest, I don't think that they'll like what you have to say. And they politely declined. This is a really good illustration of, an incubator whose business model is in direct conflict with what they're teaching. So this is also a discussion we need to have. We also need to reform education. Another thing I neglected to mention, but I'm going to mention now, is that I actually started a class at the University of Amsterdam that's called Post-Growth Entrepreneurship. I already piloted it pre-pandemic, and it's launching in January with 120 students worth 6 ECTS points, where all of the stuff that I'm talking about today and in my previous TBLI talk, this is all going to be presented to university students who are the next generation of business leaders. And this is being hosted by the business school of the University of Amsterdam, where we're going to be making professional video recordings. I would love to make a MOOC out of it, and hopefully we can get other business schools on board with also presenting similar content. So I agree with you completely that reforming finance only is not the answer. But we need to understand, bootstrapping your companies is great, but there's still a whole bunch of capital that's being used to ruin the world. And then the question really then with that capital is how can we change things so that that capital is no longer ruining the world? The other question I think we consciously need to address is what I would call the Mariana Mazzucato problem. So Mariana Mazzucato is a economist from the University College London, and she has written several amazing books, including one that's called The Entrepreneurial State. Her thesis is that the government is the world's largest VC, and but the problem that we're having is, despite all of the wonderful investments that they are making, from fundamental research to roads and power plants, we are basically socializing the costs and privatizing the benefits. And we need to also investigate, well, how can we stop this from happening? And a really good illustration of this Mariana Mazzucato problem is Tesla and Elon Musk. The sheer amount of environmental subsidies that Elon received, for building a company related to solar vehicles and also solar panels and space flight and, all of his various companies. And somehow he managed to extract that money out and put it into his own pocket, mostly through equity compensation. How can this happen? People think that Elon is, as the richest man in the world now, that he's some kind of genius. I think he should be a criminal, because I see this as misappropriation of government funds. And of course, now that the economy is in a recession, Tesla is near the point of going bankrupt. Is Elon pulling into his really deep pockets now to save the company? No, of course not. Instead, he's basically, using all of his acquired capital to buy Twitter. Oh, wait, maybe I'm not. But the point is that, this kind of extraction and this misappropriation of public funds shouldn't happen. But the problem is with government valorization, and also government funding of different kinds of projects. The government doesn't have any patience to bootstrap. The government is always just going to want to plunk down some money somewhere with some commercial party and just have something happen. That's never going to change. So in those situations too, we need to get the government to understand that they could better put that money with non-extractive fund managers or with building non-extractive companies to ensure that that money is not, the value of those companies is not getting pulled out and putting into the pockets of a very small number of people. Because if you look at the mechanisms by which this is happening, things like stock buybacks, right? We all know that stock buybacks are part of the problem, but how is it that we are not considering this to be insider trading and market manipulation? If you look at Apple, for example, who's like the largest offender for doing stock buybacks in recent years, let's consider this situation. You've got Tim Cook, who's just like, gee, we've got a whole lot of money. Then you've got Warren Buffett, who happens to be friends with him, who's like, gee, yeah, you guys really do have a whole lot of money. Don't you think a lot of that money would be much better spent by giving it back to the shareholders? Then Tim Cook, has a look at his compensation package, realizes there's a shit ton of stock in there, and says, "Why, yes, Warren, I think that's an absolutely incredible idea." And then he proceeds to do record amounts of stock buybacks, which are pulling value out of the company. Don't tell me that Apple has nothing better to be spending that money on. And this is part of the reason why companies are having problems even being companies. And don't tell me that Apple products are with all of the mistakes they've made, they're getting less popular. Everything from the eliminating the MagSafe ports to the what's it called, touch bars to, eliminating almost everything. Mac sales are not getting any better. Don't tell me there's nothing else that company couldn't be doing. But the problem is nobody looks at these things like stock buybacks through that lens. through of again market manipulation and and insider trading. It's similar also with the startup ecosystem itself. Unicorns, they are basically companies that are worth $1 billion valuation or higher. We are teaching our basically our startups that their success, their role models are these unicorns, and we are treating these startups like battery chickens, which basically means that we are force feeding them with investment capital so they can sort of get plump and juicy so that value can be liquidated after 3 to 5 years. We've thus created a system where 90% of startups are failing because that kind of hyper growth, of course, is revenue losing, and most companies won't survive it. Also, this whole thing is being funded by the LPs, and 65% of all investment in U.S.-based pension funds, U.S.-based investment funds is pension funds. So when we ask the questions about, whose money are these revenue bleeding unicorns like the Ubers and the Airbnbs, whose money actually are they spending? They're spending our money, right? So when we talk about unicorns, we need to get rid of that term, and we need to instead call it a pension fund subsidized monopoly ring, because that's what it is. But nobody is looking at the startup ecosystem under the lens of monopolistic legislation. And they should be, and the thing is, this also is not just a left-wing issue. It's also even an issue on the right too. And I think this might be a potential way that we can even unify the political parties. Because if we consider, like, I live in the Netherlands, so I can really only talk about, the parties that we have here. But we've got this party that's called the VVD, right? And they're a fairly right-wing party by Dutch standards, and they're sort of the party of business. However, they're extremely anti-monopoly. And if you can basically go to them and say, hey, look, the markets are broken, and structurally our business startup education is, its sole purpose is to create more monopolies. That's sort of, I think, the moment where their ears will perk up and they start listening. Even with the right-wing Christian parties, if we can just explain to them that usury in the Bible and in the Quran and in Judaism as well, and pretty much every major religion is a sin. To the point that Jesus, kicked the moneylenders out of the temple district, that kind of sin, and get them to understand that this is also a religious and spiritual issue, and this is, I think, the narrative that we need to get people to understand, that if we really want to solve the world's problems, we all need to be pulling together on this, because in the end, that the right wing too, they're also suffering, from inequality. Certainly the small guy is. And the problem is most people don't understand all the moving pieces of the system. Because, the reason why I think I came in as an outsider and why I have a lot of these thoughts is because I wasn't indoctrinated in business early. I don't have a business education. I just read a lot and think critically. And I come in as a computer hacker and I look at the system, and what do computer hackers do? We take a system and we pick it apart into different pieces. And because I want to know, what are the moving parts, right? How do they fit together? And once we really understand all of these levers, and understand that's what the moment when we can start to ask questions about, okay, but how can I maybe turn this lever over here to get the system to behave a little bit differently? But again, this requires coming in sometimes, I think, with this outsider's perspective and understanding that just because, things are the way that they are, just because there's certain narratives, just because we accept certain things as normal, like the 2 and 20, that it doesn't have to be this way.
No, that's for sure. But it's important to remember that, at least according to Credit Suisse, there's 4.4 times more wealth than GDP, which is why you got all this stuff, buybacks and all this other garbage. And I remember the head of Goldman Sachs in in the Benelux said to me, I said to him, you know, I can't prove it, but I have a feeling the investment manager is wrong half the time. And he said to me, no, three quarters. So I thought, wow, would I go to a dentist, a car mechanic, a gynecologist, or anyone if they were wrong 75% of the time? I guess that's okay if you're a professional baseball player, but they're all overpaid by a factor of four. And as long as the market is doing well, they'll do well. So I applaud and admire the fact that you're doing this. It's long overdue. It's a tough sell because the concentration of wealth is just getting more and more. And yes, Elon Musk is not a genius. He got a lot of free rides, and the first thing he did is he moved from California to Texas, the fraud factory center of the world. So I appreciate very much your thoughts, and I know you're also very accessible. So for the ones that are listening to this, we've also live streamed this to our YouTube channel. The number of people still in the room is quite small, so it'll be really hard to do a mixer with such a small number. But let's make a group selfie to prove that you were actually here and not, laying on the beach somewhere, getting a tan. Just wave to the camera, and the camera will make a photo of you, and then I will send everyone there. I'll ask, Melanie, if you could send the list of those nonprofit institutions that you were mentioning in your talk, because there was a request about that, and then I'll send that to everyone. What can we do to help you, Melanie?
Right. So I think there's a couple things that you all can do to help. If we're not having a mixer, I would like to do a mixer if it's possible. But
right,
but if
try, it's just there's still 11 people. I'll run the mixer and we'll see what happens. But it's possible that I'll do 3 cycles.
Sure. But for those of you who want to speak with me and who don't have the opportunity during the mixer, reach out to me on LinkedIn. Just to connect with me, send me a message. I will be more than happy to make the time for a phone call. The other thing also is, if you want to help me, please do a couple things. One, talk to me and tell me your point of view, because I realize there's still a lot of things that I'm missing. I'm sure that you all, from whatever position you happen to be inhabiting, you probably have contacts that I don't have. You probably have knowledge that I don't have. And just some brainstorming already helps me tremendously. Another thing also, if you know of any finance or investment related events that are looking for a speaker, please push me forward, because I'm really trying to spread this message as far and wide as possible. And thank you, of course, Robert, again, for giving me the platform to be able to do this. But the more people we can involve with having these kinds of discussions, it starts with an idea. And it's only once enough of us have talked about it that we can start to take action. So that, I think, also really helps tremendously. And also, if you yourself, are a fund manager, or you're a limited partner, or any fund managers or limited partners, and maybe you want to experiment with this stuff. I mean, theory is one thing, but the only way that we are really going to be able to test this and really see if everything that I'm talking about works, if it actually helps, if it really makes a difference, is by building it. And this is where entrepreneurship comes into things. Being a fund manager is also a form of entrepreneurship. So in that sense, any of you, if you're interested in getting involved in these things, again, please reach out. And also just understand that there are so many other great, wonderful associations out here that are doing really forward-thinking work in this area. Check out the organizations that are doing this shareholder activism, and please support them. I mean, again, Share Action, follow this, shareholder commons, as you sow. I mean, there are so many, and they're doing such wonderful work. And also on the institutional investor side, other initiatives like the pre-distribution initiative from Delilah Rothenberg, also looking at the cultural and incentive structures from the institutional investor side. Please get involved with these things. Read up on their work, inform yourself, and it's only by first informing ourselves that we'll be able to make a difference.
Okay, let's go to the party.